Hello there and a very warm welcome. I'm Julie MacDonald and this is the Goldmoney Roundtable discussion recorded at the London Stock Exchange studios. On today's agenda, what will the markets hold for the coming year? How will the constantly evolving geopolitical frontline affect investors and their options? And what role do traditional assets like gold have to play in the economy of the future? Let me hand you over now to Roy Sebag. You're going to kick off with this very expert panel. Roy, over to you.
Thank you, Julie. So I welcome everyone to our special show tonight. This year we're looking to do something a little bit different. We wanted to have everyone from the Goldmoney Insights team present, and so as a result I actually will not be sitting on the panel but rather conducting it as a host. We have today with us James Turk, the founder and lead director of Goldmoney, Stefan Wheeler, who's one of our main analysts at the Goldmoney Insights platform as well as a director of the company, Alistair MacLeod, who's head of research at Goldmoney Insights, John Butler, who's head of wealth services at Goldmoney, and Josh Crum, who's the co-founder and director of Goldmoney Inc. I think it'd be nice if we could maybe start with sort of a year in review, following up on the last 2 years of us doing this global outlook. I think our investors and customers would really enjoy that. So maybe I turn it over to you, James, and we can each sort of go over what you think was so interesting about 2017.
It felt like it was a difficult year because we tried to get gold over $1,300 several times and it kept failing. But that sort of takes our eyes off of the big picture. The big picture is that gold had risen against all of the major currencies. It was up 13% against the US dollar and up or break even against all of the other currencies. So for me, that was a major measure of what last year looked like. Silver didn't do as well as gold. The gold-silver ratio actually rose, but I'm expecting that to reverse this year, and silver looks ready to take off in the year ahead. The other major trend, in my view, last year was what happened to the US dollar. It was pretty much straight down all year long, and I don't see any reasons for fundamentally that trend to change. So I think this is going to be an interesting discussion on some of those points.
Yeah, thanks, James. And I'm going to chime in with some of what you just said. For me, if I just look at it completely independently, I think the most extraordinary economic event in 2017 was how cryptocurrencies came to the forefront of everything. And more, like I would say this is probably more an interesting event that the world basically started to rediscover what money is. I think it's much more than just kind of technology, etc. It is really kind of, I think we enter a period where people think about money and rethink money again. And I think 2017 was just the start of that. More in basically my area where I am, and I'm going back to what you said, what was really interesting is that we had two false starts, I would say, in terms of the rate hike cycle from the Fed. We had one hike in 2015, one in 2016. For both years, the Fed itself had actually signaled several hikes of 4 and 3. And then finally in 2017, we actually had 3 hikes. So now we are in this path, which the Fed finally kind of like can catch up with its own predictions, yet gold was rising again. So we're now down 5 hikes and gold is a lot higher than when we started. So we talked about this in our research several times. Higher interest rate doesn't mean headwinds for gold. It's much more than that.
Yes, I think that's right. Going back to this time last year, I think the conclusion that the panel had, and a smaller panel than we have today, was that commodity prices were likely to rise over the course of the year. That indeed happened until the last quarter when there was something of a consolidation. Mirroring that was the performance of the dollar. The dollar this year has weakened, and it was interesting that going into 2017, there was a lot of bullishness around the dollar. But it seemed to me that as 2017 evolved, it became quite clear that the new president actually knew absolutely nothing about economics. And it wasn't therefore a slam dunk deal that the dollar was on its way up. And perhaps the biggest surprise to observers, though I would say not to me, was that the Chinese yuan actually started a bull market. And I think that's going forward, that's going to be the interesting chart to look at in 2018.
I think that even though it represents only about 5% of the global economy, What happened in the UK last year, I think, is actually very interesting because the UK economy is a small open economy, is very exposed to the world, and it kind of functions as a bit of a canary in the global economic coal mine. And if you look at the underlying economic trends that really started to entrench themselves in 2017, which is a quite significant and steady rise in the price level on the one hand, and yet indications of an economic slowdown, relatively mild so far, on the other, that's a stagflationary mix. And indeed, economic theory suggests that the macroeconomic policy set that not only the UK, but essentially all developed economies implemented subsequent to 2008 would eventually create, quite possibly, this stagflationary set of conditions. We see it happening already in the UK in 2017, implying quite likely that that will begin now perhaps to show up elsewhere, including the United States and continental Europe this year. It's worth noting that a stagflationary environment is the worst for financial assets generally, both stocks and bonds, vis-a-vis real assets generally, including, of course, gold.
Yeah, but I guess being last, it's hard to not have one. In fact, I thought the renminbi and what's happening in China was the sleeper. I actually think that was one of the most important things. Although I would still put Stefan's point about cryptocurrencies and rethinking money. We've now had 2 years in a row. In 2016, we experimented with negative nominal interest rates, fixing the yield curve in Japan, some extraordinary things even beyond quantitative easing. So that was kind of a story of 16. 17, although the central banks, in talking, sort of unwound those sort of extreme measures, we started seeing what's the reverberations of what that meant and why people are rethinking money showing up in 17. And so obviously cryptocurrencies is a big part of it. And if nothing else, it's making people think about what is money, which is probably the most dangerous thing that central banks want to try to keep in the bag. And then the other somewhat sleepers are some of the little things that were happening around the edges in the One Belt, One Road initiative, and launching gold renminbi contracts, the gold exchange, and some of the developments that are happening with renminbi becoming an international currency. And then I guess the other part of it, similar to Alistair's point on the renminbi, is that not only was the price going up, but they were actually building foreign reserves again. And so of all this talk of bleeding all these reserves, 2017 was actually a very, very good year for China in both their transition and going back above 3 trillion in foreign reserves, which I think most of Wall Street wasn't expecting to happen. Yeah. Wonderful. So speaking of what is money, I think maybe the first topic that we should talk about today is gold and what we've seen in the last year and what we expect to see here in 2018 as it relates to the gold price. And I think for this real discussion, if I can throw it out there, each of you maybe bring some of your own specific skill sets. I think if I can just start, for me, 2018, I think the gold price feels very chirpy here, especially in US dollar terms. I wasn't expecting it to really rise the way it did in December. I was really impressed with that rise. I think I saw somewhere that it was one of the longest streaks of gains in US dollar terms ever. In terms of the gold price. So from my perspective, while I always believe in having a naive allocation to gold of at least 10 or 20%, especially when I incorporate what I see with cryptocurrency, to Josh's point, which I thought was very elucidating, if 2016 was the year that the central banks tried to test our will in terms of how far would we take it, 2017 was like the people's rebuttal to say, hey, be careful because we won't take much more. And that's probably what cryptocurrencies are. James, why don't you start with what you think about gold and just the gold market for 2018?
Yeah, well, to me, when you talk about gold, the most important thing is that it has no counterparty risk. It's money that's not dependent on anyone's promise, no central bank's promise, no government's promise. And when gold rises, it often rises because people actually like that safety and security aspect. It's not just a question of other currencies, what central bank policies are, but the mindset of people that because of the uncertainty in the financial system, they want something safe and secure that's proven itself over thousands and thousands of years and will continue to prove itself for the foreseeable future. So, is 2018 going to be a year when we see more people looking at gold as a way to avoid counterparty risk? I think so. And all we have to do is look at, banks around the world, extensions of the credit bubble, and the issues that cause people to move out of fiat into gold.
I have a true story. Today I tried to log into Bloomberg to check what the global market cap of equity and debt was. And to my dismay, Bloomberg had neutralized the function. You actually can't tell anymore on Bloomberg what the global market cap is. They now make you go to each individual market, and you could see that, but to actually put them all together requires a lot of work. It used to be just one function, WCAP. And I think, to your point, global assets are the highest they've ever been. Global debt levels are the highest they've ever been. What problem have we actually solved that would detract from the reasons people wanted to own gold in 08, 09, 010 rather than today? If anything, there's just more of this money printed, which allows them to buy more weight of metal, if anything.
Yeah, and look, gold's been in a bear market for 5 years. The last 3 years, though, it's been rising. So it's in the beginning of a bull market. But think about how much money printing has occurred since the 2011 peak in gold and to where we are now. It just creates that fundamental demand. There's so much money sloshing around the system, it's got to go somewhere. It's going into stocks, going into cryptos.
And that's, I think, really the key point for looking at gold. Gold is more than a price. Gold can be used as a valuation benchmark vis-a-vis any market, vis-a-vis bonds, vis-a-vis stocks, and vis-a-vis simply the money supply itself. Narrow, broad, choose your aggregate. You can look at any and all of these ratios, and gold is extremely undervalued in a historical comparison. So while the price 1,300 might seem pretty high in a historical comparison, when you compare gold to all these other forms of wealth, which of course entail risk, counterparty risk and others, actually gold's extremely undervalued now in a historical comparison, and that provides, I think, a very good fundamental valuation basis for gold to continue this bull market.
Well, speaking of valuation, obviously we've been very proud of having Stefan Wheeler join the team, and one of the things that he brought to Goldmoney, along with Josh Crum, was the Gold Price Framework Volume 1, where the two together incorporated this theory of value that has real interest rates and energy prices. Stefan has spent most of his career studying energy markets. So I wonder, Stefan, as we talk about gold, what do you think are the primary valuation metrics for the metal this year? And how do you see energy behaving as part of that input value?
Yeah, so when we look at we identified three drivers actually. One is real interest rate expectations, one is longer dated energy prices, and one is simply the changes in central bank gold holdings. And like the last one, we can argue about this, but nobody knows. But over the past couple of years, central banks have net added gold to their holdings. It's not a massive driver, but it is there. And I would assume, but that's just my guess, that this probably continues. So there's a slight support from there. So, but then we look at the two other drivers, which is longer dated energy prices and real interest rates. Let's start with the real interest rates. The interesting thing is that if you look at real interest rate expectations right now, for the next 10 years, they're in the US dollars, they're 0.5%. And the Fed expects that once they're done with the whole hiking cycle, so they need to hike for another couple of years, they must not hit any recession in the meantime. And when they're done, they end up at 3%. So 3% minus 2% inflation target, then you would actually end up at the percent. That's slightly above where it is right now in the expectations. But if you actually dive a bit deeper, you realize that the Fed uses a very different inflation measure than you have, then it's not the CPI, right? So actually, if everything goes right, so if the Fed can actually hike as they promise, there's no recession, whatever, you will end up with the realized real interest rates that are lower than what they currently are. So the market actually prices in the best scenario you can possibly have, and then some. So that is the reason, I think, why we see that gold prices are very unimpressed by these rate hikes. Because even if you go along that path, they were actually promising us it's not going to get any better, right? So we're never going to go back to the normal interest rate environment we had 5 years, 10 years, 20, 30 years ago. And it's not me saying that, it's actually the Fed saying that. So that's the second part.
Well, at least not in US dollars.
At least in US dollars, but I see very little indication that it's much better in Europe or in Japan. And then the third part is energy prices, and I think that is part of what we saw in December in the gold rally. Was part of it was actually that you had an overall move in energy prices going up. I think that helped. I don't see that being a major driver for 2018, to be honest. I think right now world economic growth isn't stellar, and oil output actually is quite good. Especially we're going to see more in 2018. That said, I mean, we are in this hike cycle where actually gold should go down, and it just doesn't. And I think 2018 will be another year where you actually see rather higher gold prices, even if the Fed is going to come and hike 3 times as promised.
I think what matters most is not so much the gold price measured in dollars in that sense. What really matters is the purchasing power of the dollar.
Yeah.
And I don't know if many people really know this, but since the Nixon shock, since America stopped temporarily, but has become permanently, exchanging any dollars for gold at all, even at the central bank level, not for us poor proles, the purchasing power of the dollar measured against gold has actually fallen 97.3%. In other words, from that 1971 date, there's only 2.6% of purchasing power left. That is what has happened to the dollar over time. Now, the idea that a central bank can control the rate of depreciation, which is the whole idea of this 2% target, if you like, for price inflation, is completely nonsensical.
It's basically like sinking in a boat and saying, well, I want to sink less fast.
Yeah, I mean, exactly. I'm going to stop bailing because there isn't enough water in the boat at the moment.
Yes.
Oh my God, I'll really stop bailing. No, I mean, it is completely nonsensical. And I think for 2018, what we need to watch is that relationship between the dollar and what it will buy. That, to my mind, is the most important thing. Now, I think that this is where the Chinese exchange rate policy becomes so important. Because the dollar's purchasing power is going to sink in 2018, I take that as a given. The Chinese, I think, also take that as a given, and what they want to do is to stabilize the price level in renminbi in their domestic economy as much as possible. What that means is seeing the renminbi rise against the dollar over the course of 2018. Now, this is important because it means that with a declining dollar, price inflation, the amount that a dollar actually buys, its purchasing power, is going to decline a lot more rapidly, perhaps, than that 2% level which the Fed desires. And in that, we have the key as to why the gold price is going to rise, I think, from here for a considerable period in the future.
If I may add something, I mean, the funny thing is that the Fed actually seems to be throwing out a 2% target anyway, right? So there is now active talk within the Fed, and you hear more and more voices that 2% might just be too low. and regardless whether they're actually ever able to control it that way, but if it actually would exceed 2%, nobody seems to care anymore. This seems to be a good thing right now.
Well, Mark Carney has to write a letter, and he's started writing letters again, I think. Indeed. I'm right in saying, to the Chancellor, explaining why he's over the 2% target. So in America, they may be ignoring it. In this country, I think they're trying to ignore it. But the fact is that they just cannot control the depreciation in terms of the purchasing power of these paper currencies.
So if I understand correctly, Alistair, your point, which is a very, very interesting point, is that the Fed is sort of in this echo chamber where they control the inflation rate, but China is about to come in and basically take their hand on that lever and control it in 2018.
I think the Fed thinks that it's in this echo chamber where it can control the rate. What China is going to do is to show quite clearly that they can't control the rate, because the rate of the dollar is going to be determined in the foreign exchanges as people move away from the dollar, because it is declining partly, and partly because America is isolating herself in terms of foreign trade. I mean, the idea of making America great, according to Donald Trump, is basically to cut herself off in terms of trade. Now, this doesn't make any sense at all on any level, but anyway, that appears to be the official policy.
You should save some of those for the geopolitical point. Let's turn over to John Butler. John, what do you think about gold markets in 2018? What should we all look out for?
Well, as I think it's important we do focus on valuations. And you can look at gold versus a number of measures. It looks undervalued. But another way to think about it is also what James mentioned regarding counterparty risk. There is this myth that is circulated in policy circles that somehow the banking systems have now deleveraged. 10 years on from the global financial crisis, and we've seen a deleveraging. But of course, you have to define what deleveraging is. And popular measures of leverage are various solvency ratios for banks. And there are many ways to look at these. But one concern that all investors should have is that those solvency ratios are themselves manipulable by the very structures and derivatives created by the banks themselves and then sold to other banks. And so you have a huge industry within the banking system to actually create phantom regulatory capital to make it look like you're well capitalized when you're not. And sadly, given the incentive system that still operates within these institutions, people are looking to extract bonuses, and they don't want bonuses in 10 years' time, they want them in 1 year's time. And so they try to bring forward the profits at the expense of the capital base. Therefore, I think we should be very concerned about these claims. And two prominent professors, Anat Admati at Stanford in the US and Professor Kevin Dowd here in the UK, have written extensive and well-detailed papers that have received a bit of attention, making precisely this point. If the financial markets begin to get concerned again that the banks perhaps haven't deleveraged, the shift in surge in demand for gold as a potential safe haven against a possible future financial crisis could be extremely supportive of the price this year. So that's kind of an option that we get a big kick, independent of the underlying macroeconomic variables that are bullish gold.
Yeah, I would go back to what Stefan said about inflation expectations. Another very interesting thing that happened in 2017 is the Fed started, and this academic echo chamber overall really started to admit that they have no idea how inflation works. I think that was another very important point in 2017. So if they have no idea how it works, one is, why are they so certain they know how to measure it? That's one thing that I just knew for so long their models were correct. Well, now they're not correct, but for sure our measurements are correct. And I think this is the year that people are going to really start questioning, wait a minute, you want my cost of living to go up? My cost of living is going up. Like, I don't care what your numbers say. I mean, it's the old joke that during the day, all these economists do is sit around talking about how there's no inflation. They go home to dinner and all their family talks about is how high the cost of living is and how everything's unaffordable. So I mean, it's just well, it'd be really unaffordable if they didn't get their paycheck from the printing press.
yeah,
exactly. So I think that things like the Phillips curve, which by the way, like Stefan and I going back to 2010 at Goldman, we laughed at the Phillips curve back then. I just have never seen statistically where labor was the driver of inflation, where there was this very tight relationship. And the only time that sort of was the case is when the money was pegged to gold. Right. So labor was the thing that was moving outside of this sort of energy realm and this base money, which was very, very well measured throughout the economy. And so I think that going back to the point of inflation expectations are very key to understanding gold, because gold is a duration risk-free asset. So if expectations change, not just on what they think the measurement is and what they think the policy is, but people just start really questioning what inflation is, we get back to that point where people want to own gold just because they know that, well, at least this has purchasing power.
But I question whether the Fed is, even cares about inflation, in the sense that in December, the New York Fed released its underlying inflation gauge, which supposedly is the most important measurement that the Fed uses to measure inflation. It was 2.95%, which is the highest it's been since 2006. It's been in an uptrend for 2 years. So on that basis, they should be raising interest rates like Volcker did in order to try to get ahead of the curve, which is another interesting point. Interest rates rose throughout the 1970s, and the gold price rose throughout the 1970s because the Fed never got ahead of the curve.
Yeah.
What Volcker eventually did is he raised interest rates to such a high level that the real interest rate, the inflation rate below the actual nominal interest rate, was 5 to 6%. That was the real interest rate. And that convinced people back then that, Volcker is really going to save the dollar because of what he's done with interest rates. The Fed can't do that today because of the debt bubble. the debt load.
And it's not only that. They would actually go, well, there's two things. Like the mechanism has changed for how they actually they affect overnight rates.
They don't have
They'd
the
actually have
reverse
to start
repo, yeah.
literally printing money to pay interest on excess reserves to the banks. Meanwhile, the rest of their balance sheet, which is yielding, I don't know what the average duration and yield on the balance sheet is right now. I'm just going to pick a number like 3 or 4%, something like that. I should know that number. But once you raise above that, the Fed's balance sheet becomes insolvent, and they're printing money to pay banks to fight inflation. Like, how exactly does that work?
Well, but the point is we're soon going to be reaching a stage where the Fed is printing money to give to the U.S. government to pay the interest expense on the growing federal debt.
Yeah.
And that's when you really are on the road to hyperinflation.
Yeah. So
The irony in this is that the one asset on the Fed's balance sheet is a note from the US Treasury for 8,140 odd tons of gold. If that goes up, if they revalue that from the current 42 odd dollars an ounce,
Well,
then
like
suddenly they're
300
solvent. Isn't it funny?
It's not, I don't think it's even enough. It's $300 billion. I mean, it wouldn't do much.
Yeah, you have to raise gold up to something like
Yeah.
$5,000 or $6,000, but that would even cause a shock to the system. That would mean people would still go into gold.
Well, we're also
Probably
making
won't raise
a base assumption that note corresponds to actual metal somewhere.
Well,
And that even assumes that the Fed is allowed to do that, because remember, the Fed is a legal entity separate from the U.S. government, and that gold is in U.S. government vaults. So they might just say to the Fed, you're going to go bankrupt, we're going to keep the gold and reestablish a new monetary system using the gold that we have.
Or
If it's
using
really
another form of currency. So
Yeah.
if we turn to the next item that we all want to talk about, before moving to cryptocurrencies, I actually think it would be great to talk about just financial markets in general, equity markets, and even volatility, the disappearance of volatility. You almost need a microscope to find it now, but it does exist. And I think the most interesting thing about volatility from my experience is it's really not about what the price of the volatility is today. It's about that convexity and asymmetry that volatility has to get these non-linear moves. And we really live in this world today where everyone believes that volatility has completely disappeared. It's not necessary. I saw something that didn't seem too credible, that maybe the Fed was involved in suppressing volatility directly or indirectly. What are your views on financial markets this year, equity markets, when we look at multiples and S&P earnings, and then how they correspond to volatility for 2018? What do you think we're going to be able to see?
Well, I'll go first on this one. I think the reason why stock markets are rising and have been rising and will continue to rise is people are exiting fiat currency. Because when you own a tangible asset, whether it's to own it directly or own it indirectly through the equity of a company, you're escaping the currency. So the example I like to use is that if you look at the Weimar hyperinflation in the 1920s, if you own the stock of Mercedes-Benz, you came out of that hyperinflation okay. If you own Reichsmarks, you did not. And I think we're moving to that kind of situation. That's why stock markets are going up around the world. That's why the US market's going up. That's why Zimbabwe is going up. It's not because they have bullish prospects for the economy, or you're bullish on any individual stocks on the stock exchange down there. It's too much money coming into the system, and it has to go somewhere.
Well, one thing that if you look at history and you look at volatility, it is no coincidence. Proper crises, proper financial crises, do tend to follow periods of unusually low volatility. It's almost as if there is this natural yin and yang in the market, that if risk premia decline too much, if investors are willing to accept too low returns, then you start getting into misallocations. Implied volatilities may be very, very low, but that is actually a danger sign. And no one can time exactly when it might blow up and the crisis might arrive, but you have this recipe in low volatility, compressed risk premia, very visible today in the markets, which is sadly very similar to what you saw in 2006 and 2007.
Isn't that a function of human nature? People take the eye off the ball.
That's probably where it comes
They start
from.
absorbing what becomes the conventional wisdom, but
Right.
the conventional wisdom is completely wrong.
Yeah, but it's also that the incentive to tell yourself that this is real. I mean, I saw article after article. When was it? Sort of August or whatever. We were in the sort of the peak. Everyone talking about volatility before they started talking about Bitcoin. Everyone was talking about volatility there, and article after article failed to mention that global central banks had bought $14 trillion of the risk assets out of the market. Like that had nothing to do with it. And so, I mean, absolutely, if there's a buyer of first resort, so they used to be the buyer of last resort, now they're the buyer of first resort, i.e. price fixing. And of course, that's going to look like things are more stable, because the only expectation is not of what the economy is doing, but what the Fed is going to do, what the economy is going to be doing. So the expectations now change to this completely subjective matter rather than, and so it looks like there's no volatility, but if you substitute the word volatility for uncertainty, you know, look at what happened in geopolitical events and even some of these markets, the uncertainty and the rotation of, you know, what's the uncertainty right now in commercial real estate or in physical stores? What's the uncertainty of, you know, traditional energy markets? What's the uncertain, like all of these things have very high uncertainty but very low volatility. And there's one function of that, and that's printing money.
There's one element which you've missed out on that one, and that is what's going to happen to the bond markets. And I think that bond yields are going to rise. And what's more important is if you look at the short end of the yield curve in US Treasuries, the yield on the 5-year Treasury has risen quite sharply in recent weeks. And what this tells me is that the banks, and that's as far as the banks will go in terms of duration owning US Treasuries, the banks are now losing a lot of money on their positions. Now, the underlying economy actually is not too bad. I mean, we can argue about GDP and all the rest of it, but people are just getting on with life. And I think that bankers are finding that they're missing out on lending to Main Street as opposed to Wall Street. And consequently, they are being forced to sell their US Treasuries after a significant fall in the price in order to lend money, to compete to lend money to large and medium-sized businesses. Now, so far, that business lending has been to finance share buybacks, mainly in the very, very big corporations. But with the overall economy and Main Street actually behaving quite well, I think you'll find that in 2018, banks will be taking losses in the bond market in order to participate in the main economy. Now, this is terribly important because it's at that stage, once we get maybe another little rise in these rates, that you'll find that the equity valuations start being undermined. And the relationship I've noticed for a very long time, going back to the 70s when I first started stockbroking, was that the bond market peaked first, then after that, the equity market peaked. And when the equity market was peaking, you find that ordinary people thought, well, this is completely ridiculous. The economy's doing well, companies are coming up with increased earnings and dividends, and yet the stock market is going down. This can't be right. And I think that's the situation that we're moving into in 2018.
So basically bonds are becoming fixed income again, and equities are becoming equities again, rather than the inverse that we had when people were buying equities for income and bonds for capital appreciation?
I'm putting it more simply than that. I think what I would say is that equity valuations are going to be driven not so much by the weight of money coming in. I mean, we know that sovereign wealth funds and all the rest of it have been out buying. I mean, the Swiss central bank has been crazy, absolutely crazy.
They buy mining stocks with no earnings.
Yeah, but I think what is going to happen is that markets are going to take their valuation cue more from what's happening in the bond markets. And bear in mind that we now have, I think the latest estimate was something like $233 trillion worth of debt around the world. This is an enormous figure. It's about 3 times global GDP. You get a rise in interest rates, you are moving into the final stage of the credit cycle, which inevitably ends in a crunch, a crisis. And I think that's something that we're going to have to watch very, very closely over the speed at which this happens over 2018.
It's interesting, Alistair. It's almost as though when I hear you speak about the bond market, it sounds to me like also the source of funding of governments is going to be impacted by this flow.
As well. And if you get a declining dollar, let's say I'm right about the dollar, you're going to get a declining dollar, you're going to get rising interest rates along the yield curve. The finances of the US government, particularly since they're trying to goose the economy with tax cuts, are going to go horribly wrong. That is the risk, I think, that President Trump is taking. And when that happens, you'll find that suddenly the credibility of the US government, the credibility of the credibility of dollar instruments starts going down. And that, again, is positive for gold, coming back to our earlier theme.
So what you just mentioned, there's an interesting aspect to this, because you, James, you calculated it, right? The Fed has actually started to unwind its balance sheet, but the banks actually have bought more than the Fed has been unwinding of these treasuries. Yep. So far it wasn't really a problem for the Fed, right? You could see they raise interest rates, they raise interest rates, they let them run off, and nothing happens. Yep. Stock markets go up. But that was because the banks at the time actually were adding to their positions rather than what you were actually predicting, that they are starting to sell these.
Exactly.
And so the question then is, who is going to buy this?
Yeah, exactly. Especially since
wouldn't we like to know?
We're seeing a capex cycle that we haven't seen in a long time too, which goes back to your point that banks would rather lend to the real economy because companies are now signaling, yes, we're ready to spend capital again. And so these things are all related, and my guess is they're not in the Fed's model. Wonderful conversation. Why don't we turn it now to cryptocurrency? But there are a few requisites for this conversation. So each of you can say what you like, and hopefully a good conversation will ensue. But when you end your point, you have to say in one word whether Bitcoin and cryptocurrency are a bubble or not. James, why don't you start?
Well, I see cryptocurrencies as an important development for a number of different reasons. The technology is important, but aside from that, we're seeing a shift in people's mentality. They're looking at what cryptocurrencies are as a means of escaping fiat currency. So my view is that cryptocurrency is a stepping stone to digital gold currency, and that gold will eventually return to the center of global commerce, not only at a commercial level, but also at an individual level. It seems to me inevitable that we're always going to go back to gold, because that's what we've done for 5,000 years through other periods of monetary folly. As for whether it's a bubble or not, I don't really see it as a bubble, because I don't necessarily see it collapsing back to zero like the South Sea bubble did or internet stocks did. It may not go to the level that some people are expecting it to go to, but on the other hand, I don't see any major collapses either. So I would say it's not a bubble.
Stefan?
I have to go next. So, no, I mean, I'm fascinated by cryptocurrency since the first time I read about it. That was like years ago, and I thought it was just an absolutely fascinating experiment that you could actually mimic what gold does, but in theory you could make it extremely useful. That was before I knew about Goldmoney. That was before Goldmoney even existed. But it was fascinating. It was completely outside of the banking system. It had no counterparty risk. I think the issue I'm having with it right now is that it is not really, we can't say it's money at this point, because it is like the function of store of value, it does not very well.
It's not called crypto money, it's called cryptocurrency.
Great point.
Gold is money. Money is gold, as J.P. Morgan said back in 1912.
But I mean, that's a conversation, like that's the big conversation we have.
I would disagree with you, though. I think at this point, with the scale of the market cap, people are using it as money. There are people all over the world, I think, that are using it as money at this point.
But
would you substitute?
Sure. Yes. Ultimately, it's not going to ever replace gold.
Would you fix your rent actually?
I think there are people in some countries at this. I mean, you have to observe the size of the market now and appreciate that someone somewhere is using this as money at this point. It's usurped just the speculative function in some markets. I'm not saying, in our markets, but I'm saying that I think that academic debate has been resolved. Now, whether it will get to the point where it can achieve that in the West will require to take down governments, topple governments. So that's going to be a little bit more difficult. But I do think that we shouldn't focus too much on the taxonomy of what it is, because it's very clear that it's become a currency, a money somewhere, and it's now much larger than many of the global fiat currencies in terms of the money stock. So the question, I guess, is, how do you see? Do you think it's a good money? Do you think there are problems with the way that it's created? Its relationship to energy. I mean, have you ever thought about mining and the proof of work?
We had this discussion in the green room before that, and I think we didn't really agree on this. But for me, the beauty of gold or now the precious metals is that it's completely embedded in the rest of our economy, right? So it is the same companies that produce copper, iron, oil. You could even go so far to lumber and grain that produce gold. And if gold is simply the money that we are mining, then you can shift around, right? So if you need more money, you can actually shift your resources towards making more money. If you need more iron, you can shift your resources towards more iron. And I think that's actually why gold has worked for thousands of years, because it's so embedded. Now, I'm talking about Bitcoin here. Obviously, there are like over 1,000 different currencies, but Bitcoin still being the main. That doesn't work, right? So you cannot just throw more energy or more labor or whatever, like more of your ingredients you have to kind of make other things at Bitcoin and get more out. It's just not designed to do that, right?
Well, the proof of work puzzle is quite analogous in that regard, but I agree that at the moment the cost of manufacturing the Bitcoin, of forging the Bitcoin, is far, far less than gold. So for example, I've recently entered into the cryptocurrency mining business, and I see it firsthand. We spend about $1,000 a day, per coin, and we produce a coin that's worth $15,000. Now, is that going to last? Probably not. But I think that the input actually, and especially being through the experience of having to build these farms or these cryptocurrency mining operations, it's similar. It's not the same.
But you can't scale it up, right? If you need more of it, you cannot just throw more.
You can never make more of it.
You can never make more of it.
Yeah, it has zero elasticity.
And so for me, this creates an issue that this actually, in my view, will create a lot of volatility, and Josh actually elaborated on this in his previous interview quite well about this. So that's a volatility you can't take out of Bitcoin, because if you need more, you can't make more, right? You'd have to bid it away from somebody else.
But I think we all agree. I think we all agree that it's not as good as a money as gold. We all agree about that. But I think
some would argue that it is. So I think what's important, is to show that. Well, first off, I don't think it's a bubble. But I also don't think it's money. I think it's a commodity, and I think it's a technology that can profoundly change, many things. The way we look at our monetary system, the way we look at personal data, this censorship resistance. I think all of that is a technology and a tool that really is we've reached sort of peak centralization in this cycle. We always get these, centralization and decentralization. Call it creative destruction in capital markets, call it populism in political, but you get to a level where the centralization is too high and the system starts toppling on itself. So I think cryptocurrency is a big part of that movement as a technology and as a commodity. But the problem I have with money, that it becoming money, is that some of its founders, likely, building on, Nick Szabo's work and so forth, they see anything could be money if it's unforgeably scarce. So the wampum, gold, these things made good money because they were good sort of reciprocal trading that it was very hard to cheat because you couldn't find, a shell of a certain length without overproducing. But Roy and I actually have a different view of money, that it's not that the humans aren't the center of the universe, and that there's a commodity equivalence in energy in all commodities. And the most important thing for labor contracts is that people expend their energy and their time for something that gives them more energy and more time, i.e. food and commodities and other base levels of the economy. I don't think you could ever fix a wage to wampum. You can never fix a wage, unless that wampum was tied to a system of debt like currency that anchored back to commodities. But Bitcoin, being its own counterparty-free asset, does not fit that. Its supply curve, its energy function do not fit that, so it's not money. It's a currency for certain things. It's a technology. It's going to change the world. I don't think it's a bubble, but it's also not money.
Wonderful. No, that's great. Alistair and John, you want to maybe give a last word on cryptocurrency?
I think I would say that cryptocurrencies are increasingly being used as a store of value rather than as money per se. What is very interesting is if you try and work out the rationale for cryptocurrencies being regarded as currency compared with state-issued currencies being regarded as currency. The dynamics behind them are exactly the same, and that is that we have to have confidence in the issuer. We have to have confidence in the means of issuing. Now, in that sense, they're exactly the same, and they are completely different from sound money, which, as we've discussed, is gold, possibly silver. And I think that the bubble that, if you want to call it a bubble, that we're seeing in cryptocurrencies is a reflection of what's going on in the paper currencies. I mean, I'm picking up slightly on James's point. As to whether this is a bubble, I think both the bubbles. Ordinary paper currencies, state-issued money, to my mind, is wildly overvalued. I made the statement earlier on that since 1971, the dollar has lost 97.3% of its purchasing power. That is a trend that is going to continue. I'm not going to try and guess the rate at which it will continue, but it will continue because that is the nature of state-issued money. As far as cryptocurrencies are concerned, people are buying that, if you like, as a store of value compared with anything else that seems to be measured in government money, equities, bonds, whatever it might be. This is the game in town. And if you look at it in that context, it's interesting because we've gone through the first phase, which really are the technocrats, the people who understand technology, understand blockchain, so on and so forth. They have been predominantly the buyers. Only now are institutions with regulated funds under management beginning to be allowed to dip their toe in the water. That is the second phase. The third phase is that the ordinary members of the public really do start getting involved. Now, so I'm saying that there are two phases still ahead of us. Where this differs, if you like, from previous bubbles, if I can call it a bubble for a moment, is that in previous bubbles, they have been limited geographically to fairly small areas. The tulip bubble, for example, which you like comparing this with, that was a small part in Holland. And not only that, but in those days, when you had sound money, if you were going to go and chase the price of something, you had to take money away from being used for something else. Nowadays, we don't have to do that. We go down to the bank, and the bank creates the credit for me to go and buy the currencies. So the potential for this to be financed by credit is absolutely enormous. And there is another point. In those old days, if you look at the South Sea bubble, or indeed the Mississippi bubble, basically, if you were within a coach ride of London or Paris, respectively, then what you would do is you would take all your money, you'd get in the coach, risk the highwayman, get into town, and then go and see the broker and put a bag of coins on the thing and say, I want some South Sea shares, or whatever it was. Now you don't have to do that. You have a mobile phone. You've got this technology. So suddenly, your location doesn't matter. What you have is something which is worldwide and accessible by a population of up to 7 billion people. So this bubble, if we can call it that, could actually run a lot further. But I think ultimately the degree to which it runs is now going to be curtailed by how long it takes for the government-issued, state-issued currencies to collapse. That's my thesis anyway.
And I'll be very quick just to draw upon that because I agree. I mean, look, what is the definition of a bubble? And the thing is about looking at cryptocurrencies is that if you do shift your focus to the dollar and other fiat currencies and you look at the way in which money printing has been used post gold standard to try and manage the business cycle, we live in an age of central monetary planning. And that central monetary planning has resulted in basically the creation of a money bubble. There is too much fiat money circulating and is destabilizing economies and causing financial crises. That is a bubble for certain. I'm more certain that's a bubble, and I'm less certain that cryptocurrency is a bubble because it's so new and it is an ingenious technology, and it would be presumptuous of me to know exactly what functions and uses and purposes it might have in future.
It's not the disease, it's the symptom.
Indeed. But I know that this underlying fiat currency system is a bubble, and just as power tends to corrupt, monetary power tends to corrupt, and gold as something not created by man will ultimately, in my opinion, trump not only paper money, but probably on any reasonable investment time horizon, cryptocurrency as the ultimate means of settlement, the ultimate store of value, something that is not created by man at all. Gold.
Fully agree, and I wrote about this in my paper, The Natural Order of Money, where essentially the greatest issue that these cryptocurrencies are going to have is this, competition ad nauseum, because they can just be created by fiat as well. So I think a good way to summarize the cryptocurrency, though, you did escape the bubble question, John, and Stefan. So we're going to have to a quick yes or no. Stefan, in a bubble or not?
I say no. May I add something?
This is not a Swiss. You got to answer it correctly once.
I think
you're going to have to offend someone.
I think it depends very much on the time horizon, right? So if you look at it far enough, I'm with, I think, everybody on this panel that there is a debt, like fiat currency bubble, and if that bursts, then you're better off in pretty much anything. So, but, the way this thing has behaved, and we're not just talking about Bitcoin. There have been ludicrous kind of cryptocurrencies that were started as a joke. Yeah. They might be useful now, but they were started as a joke, and so some of this stuff will just evaporate, in my view. So I think you cannot. First of all, they're not all the same, and it's also over what time horizon, right? Could this thing lose 90% tomorrow? Yes. But would I rather hold this than US dollar over the next 20, 25 years? Yes.
Well, there is one interesting fact as well now. We can now mathematically project that the cryptocurrencies are being created or appreciated in terms of the future inflation at a faster rate than gold is being mined today, in terms of the weight of gold divided by US dollar. Right. John, just with you, do you think it's a bubble or not?
I think it is a bubble, and you just pointed out that there may be many bubbles in the world, but demonstrably gold is not one of them. Of that, we can be certain.
Well, what's interesting is, as you guys were talking, I almost had this vision that whichever one, the fiat currency economy and the cryptocurrency economy are almost at this battle right now. And gold just sitting on the sidelines is going to basically be chosen as the date for the one that wins in this competition for beauty.
The first round bye. Yeah, let them beat each other up.
Yeah.
There is one thing I think worth adding, and that is that there are moves to try and get the whole subject of cryptocurrencies on the G20 agenda in April. So people who listen to this and think, oh, well, we better run out and buy cryptocurrencies, there could be a few choppy waters ahead.
And remember, there's always Davos, late January, where all the real backroom deals happen that they don't tell you about. So that's already that's coming up very soon.
Yeah. So with that, I think it'd be great to actually turn to some social media questions. We've had a lot of questions for this panel, and so maybe I turn it back now to my friend here, Julie.
That was a fascinating discussion. It was really meaty. There's still more to say, I think, but we do have some questions here that I think are just as important, because they're coming from people who are, using your services. They're very interested in what you have to say. The first one from Russ Jones. I don't know who's the best person to answer this, but I'm just going to throw it out there. He says, as fiat currencies all over the world start to implode, you pointed to that in your discussions, due to the longevity of this Ponzi scheme, what countries do you think will be the first to return to being backed by gold during the next crisis? Who wants to pick that one up?
Well, shall I take
sir.
Let's start with Alistair, for sure.
I didn't plant that question before. My name isn't Ross.
And no one vetted the questions.
Yeah.
I think that there is, if you like, a financial war, in effect, going on between China and Russia on the one side and America on the other. Now, America has spent the last 30-odd years, or certainly from 1970, that's 40-odd years, 43 years, trying to deny that gold has any monetary role whatsoever. However, we do know that both Russia and China have been accumulating gold, not only as reserves, but also off balance sheet, if I can put it that way. And also, in China's case, they have been encouraging their own citizens to buy gold. And so far, they've accumulated something like 15,000 tons since 2002. Now, I think gold is becoming actually quite central, if you like, in terms of a nuclear option, financial nuclear option. If President Trump really goes beyond the pale and the Chinese and the Russians feel that they've got no alternative, then they could put their currencies onto a gold standard of some sort, or they could say that they could announce how much gold they have got and drive the gold price up. And that would create, at the very least, huge embarrassment within the American financial system. It's something that we're going that way anyway, and one of the reasons for this is that China is insisting, as the largest trading nation in the world, on using its own currency for its own trade settlement. This is a process which has started some time ago and is likely to accelerate in 2018. And one of the keys to this is the contract, an oil futures contract in yuan, which would allow countries like Saudi Arabia to take yuan in for payment for their oil and have a hedging mechanism, if you like, in the market. Now, it is quite possible that some of these countries will hedge from oil yuan into yuan gold. And the contracts for yuan into gold already exist. So we need to watch and see when that contract comes in, the oil yuan contract. The latest information we have, and this isn't firm information, it's sort of traders reporting, seems to be that the date of 18th of January is set for the start of this. All the testing has been done. The actual timing, I think, will probably depend on geopolitical factors to which we're not privy, which basically will be discussions between the American government and the Chinese government, because obviously the American government does not want this to happen. So I think we're seeing huge, great changes in that sense, and it's likely, I think, to push the price of gold up, and that would certainly favour China and Russia, and also all the other countries in Asia which have been buying gold, compared with America.
I'd like to answer that as well. I think that, just like in biology, you need certain conditions to exist before life can emerge. I actually think that all of those years that we were saying that one country might go back on the gold standard, and I personally said this, it was a misguided statement because you need the conditions to be right. And earlier we had an interview and you were saying that some of these things that we're talking about, a lot of people don't know, and so we're sort of unearthing this wisdom. And I think that to that extent, the conditions that were necessary for a country to re-embrace gold were for its citizens to understand what money is, and to be reintroduced to these two concepts. Commodity money, inflation is bad. Because those are the two concepts, these paradigm shifts in thought that we've been fighting against as gold standard people for the last 40 or 50 years, ever since Keynes was misinterpreted. And so we now have those conditions. The citizenry is awoken to this concept that inflation is bad, commodity money is good. They're currently, concentrating that in cryptocurrencies. But if they take a step back and look at gold, it's sitting there ready for them as sort of a monetary system out of the box. And so I think it could be any country. We can really be surprised. It's just going to require sort of a rigorous thinker and someone that's not afraid to make this bet, on the behalf of his
Asians
people.
already understand this. I mean, if you look at the Indians, for example, I first went to India in I think it was 1967, and the price of an ounce of gold was around about 170 rupees. They have been saving in gold, and since 1990, when the restrictions came off and people were allowed to buy gold, they have been accumulating large amounts of gold in India, anything between 500 and 1,000 tons a year. Now, if you think in terms of, let's say, you're a small businessman or you're a farmer and your saving medium is gold, you have seen it go from 170 rupees since then up to a current price of around about 90,000 rupees. So where do you put your money? It's an absolute no-brainer, and Asians understand this. And this is what the Chinese government have been tapping into in allowing, first of all, allowing their citizens to buy gold, and not only allowing them to buy gold, but encouraging them, advertising gold, you should buy gold.
And I think that's actually the big difference between China and India and even some of the countries in Southeast Asia. The people through the whole region understand gold, but China's actively aligning not only do they want gold themselves as a government, but also they want their people to have gold. That sort of both conditions is most prevalent in China versus anywhere else.
My hand's shooting up here because I have a question. It's not a social media question, but is there another country looking to China and watching this activity and saying, actually, that's a good shout, we should do that?
Well, China may be the biggest economy, but actually, of all the countries that have been mentioned in this discussion, Russia has, relative to its own domestic money supply, by far the largest gold reserves. Today, Russia can back nearly half of its entire money supply with official gold reserves, much higher than China, much higher than anyone else.
But that's the government, but they're not actively pushing.
I know that, but as an instrument of policy, Russia is actually ready for a remonetization of gold in a way that other countries may not yet be as far along.
I think China's best prepared by far, and because what a lot of people don't know is that China is not just the largest consumer of commodities in the world, it's actually also the largest producer of commodities.
Yes.
And for a number of years now, including gold. So like if you add up the value of all the commodities produced, including oil, I've done this back at Goldman a couple of years ago, it might be that with the oil production in the US, maybe the US has overtaken this again, I'm not sure. But China has, in that relatively small space where they are, and I'm not talking about production of Chinese companies somewhere in Africa or South America, etc. Really, what coming out of the country itself. China is the largest producer of commodities, including the largest producer of gold, which is actually where all that state-owned gold is coming from. They're actually buying it from themselves.
Yeah.
So, I mean, there is a strategy behind it, which I think no other country can match or has matched at this point.
I think the answer to your question is that there are two types of countries in the world today, or three. There are the first kind of set of countries which just have cognitive dissonance. They have no clue that any of this even matters, and they constantly proselytize that through their academic departments or through their political departments. And then you have two subsets of countries that understand that it's important because they're generally have to balance their budgets and they have population that they have to try to get upward in social mobility. And within those two, you've got kind of a collection of countries that are preparing for it on an official capacity. Whether they then distribute that wealth to the people or enrich themselves, we don't know, as in the case of Russia. And then you have another group of countries that are actually not only preparing for it officially, but they're preparing their citizens for it in practice. And those are the countries that will thrive in sort of this new order if it does materialize.
Can I just add a point? And that is, this is why the yuan dollar rate is so important. Because I think in 2018, if I'm right, and the use of the dollar as a trade currency of choice is going to be declining and the use of the yuan is going to be increasing, then quite a few countries will switch from having, let's say, a currency board arrangement against the dollar to having a currency board arrangement against the yuan. Angola, for example, all her oil exports to China are paid in yuan. Iran is the same. Saudi Arabia could well be the case. I mean, we know that the governor of the central bank went and met the Saudi finance minister on the 27th of December. And I would guess that this was the sort of thing that they were talking about. So I think that what we might see is countries realigning themselves over the next 18 months or so from the dollar towards the yuan. Now, if, let us say, the yuan begins to discount a gold element in its valuation, then de facto what we're seeing is part of the world moving over towards some sort of very, very loose gold standard by default.
Fantastic. I think Russ got great value on that one too. I've got quite a few questions here, so I'm going to try and burn through them just so that everybody gets an answer. So we've got Gaurav Varshney here at TGW Tom. He says, what's Goldmoney's hedging strategy on cryptocurrency receipts and revenues?
I'll answer this. So we don't need to hedge cryptocurrency because it's a fully reserved platform. So when a customer buys cryptocurrency from us, they're actually immediately owning that cryptocurrency in a cold wallet. And so we're never standing in between, taking positions that are disadvantageous to the customer. We've really taken our ethos with gold, fully reserved, fully allocated, fully redeemable, and we've sort of mirrored it in our cryptocurrency offering. So we don't need to hedge because we are not really long the cryptocurrency. It's the customer that's long. Now on our balance sheet, we will from time to time take speculative positions in cryptocurrency, just like sometimes we do in precious metals. But in that regard, we just keep very tight stops and we never really let the position get too big.
I'm just going to concentrate with you, Roy, for the moment, because I've got another question also from Gaurav here. And he says, what's Goldmoney doing to stay ahead of its competitors? And a further question. And is it a given that crypto investment has been a drag on gold price? And if so, can this be quantified?
Yeah, so the first question, I mean, I don't think there's actually a real legitimate competitor to our business, because when you look at the scale of our business and all of our offerings, and when you look at the health of our balance sheet, and really, to compete with us at this stage, you can't just compete with our service offering. You have to compete with all the qualitative layers that we've sort of erected around our moat, which are things like being publicly traded, being audited, having the scale of our balance sheet, being backed by the investors that we're backed, and then building the infrastructure that we've built. I mean, I've seen many companies launch their businesses on one feature of our technology, when that's just one feature. So I think that in terms of staying ahead, we have an inner scorecard. We don't rate ourselves based on what our competitors do. We rate ourselves based on, we wake up in the morning and say, how do we make this platform better? How do we protect our customers' funds? And how do we make decisions that are always very long-term oriented? We're never going to chase the trends that other people are chasing. Even with cryptocurrency, we had a working cryptocurrency platform with patents and with technology in 2014. And yet we didn't feel comfortable enough to offer it to our clients until August and September of this year because there were a lot of reasons. We actually didn't know. And one of the things that we always tell our clients and our investors as well is that we're not afraid to be wrong. We're not afraid to make mistakes and change because it's very important, especially in investing. One thing that I've learned is you have to be able to change your decisions. You can't just be stuck on one decision. And we maybe could have gotten into cryptocurrency earlier, but we're very happy with the solution that we offer now.
Second question, just to remind you, is it a given that crypto investment's been a drag on gold price? If so, can you quantify this?
I think that that's a refutable fact that's been falsified. I mean, gold is up 13.5% in US dollar terms for 2017. And I would argue that where the fuel for this cryptocurrency demand is coming from fiat currencies. Now, with that being said, I have observed through my interactions in the industry that the demand for silver coins, which was a fat margin business, it was a 3 to 5% margin business, has eroded because that sort of demand required a lot of stimulative efforts. In other words, whereas gold's demand doesn't require so much stimulative efforts, it's more of a stock flow equation. There's more demand for gold as more money is printed, et cetera, et cetera. With silver, I've always noticed, especially with the coins, that you needed someone on the phone to promote you on silver. You needed someone to really call you and get you to buy it. And those businesses are suffering. We can see it, all of those silver coin businesses. And I think that they've been replaced by the ICO stock jobbers and those kinds of people. But I think that net demand for the silver metal isn't down. It's probably being used in industry, and net demand for gold metal isn't down.
Can I just add one thing to that? Our own results sort of refute that premise because we actually increased the weight of gold in the past quarter from what it had been previously. And part of that is because we do offer cryptocurrency. So a lot of people who have made a lot of wealth in cryptocurrencies are doing what people have done for thousands of years. They've moved out of that form of wealth into a safe form of wealth, which is owning physical gold. So I don't buy that premise that it's taking away from the gold market.
Another question here from @WholeFrance90. With the VIX being at 9.22, would you expect the gold and silver market, to increase in value in 2018? I see nodding.
Well, I mean, as per our discussion of volatility earlier, it's almost certainly unsustainably low. It just cannot stay this low for so long without causing some sort of crisis. This is what history tells us. And so it is, call it an accident waiting to happen if you want to. And so this will become supportive of the gold price in time as volatility at some point begins to ratchet higher.
Yeah, one thing that about volatility that people like to trade is sort of the convexity, and they try to actually be constantly selling volatility because of the curve. But the problem is that people that want to be long volatility have to fight that curve. And so it's actually very hard to just sit there and buy volatility. So it's much better to just sit there and buy a duration risk-free asset like gold. When volatility spikes, gold goes with it. So gold's just actually a better way to play unnaturally low volatility.
And also the whole idea behind this, that low volatility is bad for gold prices, comes from this idea that gold is driven by greed and fear.
Yeah, exactly.
Which is
that's a great point.
Which is something you read when you open Bloomberg and like read media reports. It's always like, like North Korea, now gold goes up, and no North Korea, now gold goes down.
And we've seen our customers sell gold those days.
It's just really not how it works.
Just echoing that point, I think that if you take this step and you watch these outlooks for the last 3 years, now our third outlook, and you reach the conclusion that we've reached, which is that gold is money. It's money in nature. You don't really care about correlations like volatility down, gold up, volatility. What you then begin to realize is gold's always really staying the same relative to gold, and it's everything else that's jumping around randomly almost, Brownian motion of sorts. And over time, everything else seems to decline relative to gold, just like it does in nature. Yeah. Just like it does in nature.
Yeah. It's like being on a boat looking at the shore. being on the boat is dealing in fiat currencies, and you think that the boat is going up and down, but it really, the shore's not moving up and down, it's the boat moving up and down. And what you need to do is get on the shore and look at the boat, because once you're on the shore, you're actually using gold for your calculation, and it's the fiat currency that's going up and down, but that boat actually has a hole in it because it's not floating, it's actually sinking. It's losing purchasing.
Just like that Federal Reserve official that wants to tell us that 2% inflation is good.
Yeah, exactly.
So this is our last question.
Last question, gents, from social media. This is from Solo Finances. Are you expecting deflation or inflation in the coming years, or perhaps a combination of both?
Well, I think you have two things that happen in these cycles. Is you have asset price inflation, and then you have wages doing something here. And as long as this gap is opening, you're going to have a lot of social problems. And so one of two things has to happen. Assets have to decline back to that level where most people are earning their income, or income has to inflate up to the level of the assets. So in some ways, it doesn't matter whether it's one or the other. That really is on central banks and how they choose to allow currencies and markets to function without trying to manipulate a perfect equilibrium where this just keeps growing forever, because that just doesn't happen. Because as we're already seeing in the social realm, things will start breaking down.
But central banks have stated policies they want inflation.
Yeah.
They're not going to let any kind of
That's what
inflation
happened
occur.
in the 70s. I mean, the stock market went broadly sideways, but inflation accelerated and eventually got into the double digits. And so wages went with it, and you saw a convergence in this inflationary way. That appears to be policymakers' preference. The problem is, though, because it's already been their preference now through multiple cycles to bid up the asset values to just astronomical levels, high multiples, so on and so forth, it could be some mix of deflation and inflation next time around. You could have a bit of a crash on the one hand and inflation catching up at the same time. So it could play out more simultaneously in the next crisis. That's a possibility.
Probably iPad's going to get cheaper. We can probably bet on that. And everything rich people buy will probably go up in price.
One thing I don't like about modern macroeconomics is that definitions of whatever it is, whether it's inflation or deflation or whatever, are so loose that they can mean anything you want. So let's put this into context as far as the question is concerned. If you go back to the hyperinflation in 1920 to 1923 in Germany, if they had measured GDP at that time, GDP would be going up like that. I mean, sorry, I mustn't do that. But anyway, GDP would be really rocketing. And everybody would be saying, well, this is wonderful. I mean, modern economists would be saying this is wonderful. But actually underlying it, there was starvation. People were losing the value of any money they had so rapidly that they were effectively forced out on the street. They had nothing. They were impoverished. So in that sense, if we're talking about inflation and deflation, in sort of modern macroeconomic terms, you have both at the same time. So it's not something that is mutually exclusive.
Well, I think you always, if you don't have a good position in gold, you always have inflation in the things you own and deflation in the things you need.
Well, what happened in those days, the people who did extremely well were basically foreign students who went to the German universities, and they would have an allowance from home. And the allowance was, say, dollars or sterling, whatever it might be. And that, because those currencies were tied to gold, effectively, they were getting paid in sound money and enjoying a standard of living in supremely unsound money. And that was the real difference. And these were the people who did very well out of it. In Austria, for example, after the war, British soldiers went and stayed in the top hotels in places like Salzburg, and it cost them absolutely nothing out of their war pensions. And this was the sort of distortion that happened. Wonderful if you were a British soldier enjoying the beer for virtually free and the hotel rooms for virtually free. But this idea that you can just turn around and say it's either inflation or deflation is complete nonsense.
I can't wait to come back and have this discussion. We're going to wrap there, gents. Thank you so much. In a year's time and see how much more that there is to talk about. So yeah, from us here at the Stock Exchange, thank you so much for joining us. And I hope you've had as much of an education as I have. Thanks.